So one of the very cool things that comes with options selling strategies is that the expiration date of your contracts does not necessarily have to mark the end of your trade, right? And that's why in this video here, I'll be showing you in regards to credit spreads and iron condors, how you can both extend the duration of those kinds of trades if, let's say, by the expiration date, you're still down money, and also reducing the risk on the trade at the same time. And the way you achieve this is through the concept of rolling, which is basically the more general focus of this video, right? How to roll credit spreads and iron condors. And simply put, rolling is the process of closing your existing position and then opening the exact same position or something very similar to it in a further dated expiration cycle, right? So you are basically moving your position further out in time to the next expiration. And also when you do so, under certain conditions, you will collect an additional credit. And that's the piece that allows you to reduce the risk on your trade, right? Because for defined risk option selling strategies like credit spreads and iron condors, the more credit you can collect, the less and less and less your max loss is going to be, and therefore the less your risk is going to be. Now, like I mentioned, there are some conditions that do have to be met in order for you to roll your position for an additional credit. Sometimes you can't actually do this. And so that's why for the rest of this video here, I'm going to walk you through some very detailed examples, mostly focusing on a call credit spread. But as you'll see, this can be applied very easily to put credit spreads and iron condors too. But these examples will very clearly illustrate those exact conditions where you can and should roll out your trade, and then under what conditions you should not roll out your trade and simply cut your losses and get out. Now, as always, before we dive in here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. All right, and so with that being said, at this point, we're going to jump on over to thinkorswim here and we'll get things started. All right, so now I'm going to walk you through some very detailed examples so that you can see not only just how to roll out a spread-based trade, but also those various conditions under which rolling out is even possible, or that you should even do it. So now coming to the charts here, the stock or ETF I'll be using in my examples is going to be SPY. This is an ETF that tracks the S&P 500. So now let's go ahead and zoom in a bit. And I do apologize for all the stuff that's on my screen here, but let's just say for the sake of a very simple example here that you are bearish on the S&P 500. I know I certainly am. And so perhaps during this time period here, when the S&Ps were falling pretty much every day in a row and breaking through all these various support levels, perhaps somewhere around this time you decided to step in and sell a call credit spread. And perhaps maybe it was on this day right here where you actually sold that spread, right? As SPY was breaking down below this major support level. Let's say for the first example here, you sold a call credit spread, as I said, with a short strike of 435 and a long strike of 445, right around there. So that's going to be a $10 wide call credit spread, and perhaps you collected maybe $200 in credit for putting on that position. And of course, because your 435 short call strike was well above the trading price of SPY at the time, right? As with this candle here, SPY finished the day all the way down at around $420 per share. So that means for a time here, your trade was looking pretty darn good. But then, of course, fast forwarding to the present, as you can see plainly here, the stock market has bounced back quite a bit. And now, as of yesterday, SPY closed at 437, almost 438. So that is now above your short call strike, and therefore, you're going to be facing losses on the position now. And in particular, let's now come over to the trade tab and take a look at the actual option chain on SPY. Let's say when you first put on that position, you sold those contracts in the March 4th weekly expiration cycle, which now, as of today, only has 1 day left until the actual expiration. But of course, at the time you entered the trade, perhaps there were 10 days to expiration. So we'll unfold this tab here and take a look, and then we'll scroll down to the at the money options, or to where your strikes would be in this example. So again, for this example, keep in mind your short call strike is at 435, which is now, as I said, in the money. And then your long call strike is all the way up here, still out of the money, at the 445 strike. So basically, this spread is only partially in the money, And let's go ahead and take a look at the current price of this spread. So I'll go ahead and set up an order, specifically in order to buy back this credit spread. So we'll go to buy and then vertical. And here we go. So if you wanted to close this position right now and simply exit the trade, you would have to pay a debit to do so of $448. And so if you initially put on this position for a credit of only $200, that means you're going to face a loss. Right, briefly, if you bring up the calculator real quick, and I'll move this right over there. So again, if you sold that credit spread at the beginning for $200 as a credit, but now you have to pay a debit of $448 to close it, you're going to lose $248. And of course, you could hold this trade for one more day until the actual expiration date, and something might happen. Perhaps SPY might move back down in your favor, but who knows? It could also continue moving higher. And so therefore, if you are still bearish on SPY at this point and you wanted to extend the duration of this trade and also reduce your risk on the trade, then this is a great situation to roll out your call credit spread. So now in this case, what you would do is still buy back your initial call credit spread, but then you're going to open the exact same position in a different expiration date with much more time left. So for example, let's scroll down a bit here to the next expiration cycles. So perhaps I wanted to give myself 2 more weeks on this trade to be correct, and therefore I want to roll out this spread to the regular monthly contracts that expire on March 18th, 15 days left to go. So we'll unfold that tab and scroll down to the same exact strikes. And also I should say you can change your strikes a little bit in this future expiration date, but you will not be able to change them by much because, as you'll see here, you always want to take in an additional credit when you roll out your contracts. So for the sake of simplicity here, I will choose the exact same strikes. So now in this expiration, I'm going to sell the same 435 strike short call option and then buy the 445 strike long call option. So I'll go ahead and very quickly set up that order. And here we go. So now I have 2 different orders. Again, the first one is to buy back my initial call credit spread and do so for a debit of 448, right? But then as you can see here, by opening up the exact same position simply with more time, in a future expiration cycle, I can do so for a much greater credit. So now, if I bring back the calculator real quick, again, if my initial credit on this trade, when I first put it on was $200, and then now with this series of orders, I pay a debit to buy back my initial spread, and that debit is $448, and then finally putting on the new spread for a credit of $569, that actually brings my total net credit on the whole trade to $321. So I have basically added $121 of additional credit on top of my starting credit. And also, of course, I've given myself 2 more weeks on the trade to be correct. And just to make things clear, right, when you take in more and more credit, you are also reducing your risk, right? Because spread-based trades like credit spreads or iron condors always have a maximum loss. And that max loss is calculated simply by taking the width of the spread and subtracting from it the credit you are receiving. So therefore, the more credit you collect over time, the less and less and less that max loss is going to be. And you can also continue to do this again and again and again and just collect more and more credit until you either simply want to exit the trade yourself or you find yourself in one of those conditions where rolling out for a credit is no longer possible. So now let's explore that condition. So back with our initial example, the reason why you can roll out this spread for a credit, basically the reason why this new spread here is worth more than the spread you are buying back is because these spreads are hardly in the money. Right, again, SPY right now is only at $438 per share, at least as of the close of yesterday's market. So therefore, your spreads here are only $3 in the money, right? 438 is only just above your short call strikes of 435. But as you will see here, the more and more in the money your spreads become, the less and less credit you'll be able to collect when you roll out the spread until you actually can't do it at all. So now what if my initial spread was not the 435, 445 spread, but perhaps the 431 short call strike and the 441 long call strike? And so again, with SPY at 438 one day before expiration, your short call option is now super far in the money and your long call option is only a little bit out of the money still. So at this point, if I wanted to try and roll out this spread, again, we'll go to the same exact strikes in the March 18th cycle. So 431 short call and 441 long call. Now you can see the prices of these spreads are almost exactly the same. To buy back my initial spread, I pay a debit of $6.17, and then to sell the exact same spread in the next cycle, I receive a credit of only $6.30. So the difference here is only $13. So therefore, if I did move forward and roll out this spread, my initial starting credit of $200 would then be increased to only $213. Still not terrible, right? I've technically reduced my risk a little bit, but at the very least, I've still given myself 2 additional weeks to be correct directionally on this trade, and that's definitely not a bad thing. But now finally here, one last example. Let's say instead of the 431-441 spread, let's say I initially sold the 425 short call option and then bought the 435 long call option. And then I'll go ahead and change the strikes on this one here too. And here we go. So now if I wanted to try and roll out this spread, the debit I would pay to buy it back is almost $800. And then with trying to roll it out in time, I would only collect a credit of $712. So ultimately this means, I'll bring back the calculator one last time. Again, if my initial starting credit was $200, and now I have to pay a debit of $798 to buy back my initial spread. And then if I only collect another $712 to sell that new spread with 2 more weeks until expiration, my total net credit on the entire trade has fallen down to only $114. So in this case, I've still extended my trade duration. That's not bad, but I have increased my risk on the trade. I now have a smaller credit, and therefore the max loss on the spread is larger. And the reason why this is the case for spreads that are in the money, it's a bit complex, but essentially it has to do with the extrinsic value in the long call option, the new long call option that you're buying in that further dated spread. So basically this 435 strike long call option that you have to purchase now as part of the new spread, this option here has the most extrinsic value of all these contracts. And because you have to purchase this one and not sell it, that's why the net effect here is you actually lose money by rolling out the entire spread. So in conclusion here, only roll out a spread-based trade if you can do so for an additional credit, or at the very, very least, if you can do so for no credit or debit. Basically, you just don't want to continually increase the risk on the trade if you roll it out again and again and again, right? You either always want to reduce risk or at least keep it the same while also extending the duration of your trade. And this issue here with rolling out spread-based trades is actually one of the reasons why I prefer to sell naked options, right? Because instead of here selling a call credit spread, if I chose to just sell a naked call option and did not buy a call as part of the position, then I can actually always roll out that short call option for a positive additional credit. Basically, whenever you can't roll out a spread-based trade for a net additional credit, it's always because of that long option that you have to purchase. So of course, if there is no long option as part of your trade, then again, you're always going to collect an additional credit by rolling out in time. That being said, credit spreads here are still definitely a great strategy. All I'm saying is do keep that point in mind about selling naked options as well. And also one last thing here, I know in this video I did not talk explicitly about iron condors, but you can roll out those kinds of trades in the exact same way as a credit spread. The one major difference, of course, is that with an iron condor, this trade is comprised of 2 spreads, right? You have a call credit spread and a put credit spread. So basically, you'll have to roll out both those spreads independently. But again, my point here still stands that if you cannot roll out those spreads for a total positive additional credit, then do not do it. Just close the trade and perhaps try again with a brand new trade, right? In my opinion here, it's never a good idea to continually increase the risk on a trade in the hopes of potentially being correct, when in reality, you may never be correct. And obviously in those cases, it's going to be a really bad idea to continually increase your risk, right? Because eventually you'll have to exit the trade and your loss in that case is probably going to be much, much larger than you initially thought. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.